Bakam, good afternoon. Can you hear me? Can you hear me? Good afternoon. Good afternoon.
Good afternoon, sir.
Okay, I wish you can hear me properly.
Okay.
Okay. Last time. Last time. Okay, last time we were going through branch accounting, and I think we did the first part of branch accounting, which was dependent branches. We did a past paper question of September 2015. And I had promised that we'll proceed today with independent branches. I had promised that we're going to proceed on with independent branches. Now, okay, we want to proceed with independent branches, but as I have just noticed is that the question I intended to do for independent branches is for 2014, and since we don't have that sitting, I'll make arrangements to have the question printed and availed to you so that we can be able to proceed on with independent branches. So I'll have to postpone that. Meanwhile, we proceed on with what we had said. We had said that after branch accounting, we would proceed on with group accounts. So not unless you have a question, just allow me to kindly postpone independent branches for that inconvenience, and we proceed on with group accounts. I introduce group accounts.
So, just a minute, sir.
Okay.
We are postponing the independent branch and the foreign branch.
Yeah, both of them, yeah. Because the subtopics are related. I cannot be able to proceed with foreign without independent.
Okay.
Yeah, just bear with me for now. I'll make sure that the paper for 2014 is availed to you so that we can be able to do independent branches.
Then, I had a question.
Ask.
Okay, back to the example we did.
Okay.
We had been in the question.
Yes.
We had been given a markup.
Yes.
We converted, which was 3/5. Yeah.
Yeah, you're right.
Which we converted to margin.
Yes.
Which became 3/8.
You're right.
So I was saying, at what point do we use markup directly?
That is where goods are transferred. Supposing those figures which had been given there had been stated at cost. That is when you use markup. But as I can see, just before the schedule, there is somewhere where you are given the amounts are stated at selling price. Yeah, that is why we use margin. But basically in financial reporting, we apply margin. I don't think there is a scenario whereby you'll be given those details of those figures at cost. They will always be given at selling price. Are you answered?
I saw a question.
Yes?
I saw a question that the given figures,
Mm-hmm.
they were stated at cost.
In such case, you would apply markup. Was it a past paper question?
It was I saw in some notes.
Oh, maybe. Because in exams I've never seen, but either way, it is possible. When you're given figures at cost, you apply markup.
Then I also came across another part
Okay.
that was a little confusing,
Yes.
where they were talking about
Yes.
As in the additional information about some questions that I saw,
Okay.
they talked about markdown, and then in the workout,
Yes.
the markdown was okay. When the markdown was being captured in the inventory account and the markup account,
Yes.
at one point they applied double entry, and
Yeah.
another incident they didn't apply, so it was a bit confusing.
Okay, the markdown concept is supposed to be captured through a double entry, whereby the amount is credited in the inventory account and debited in the markup account. It actually uses a double entry concept.
So it's always double entry.
It's a double entry concept, yes. Any other question? Okay, let's proceed. So I'll introduce this new topic, and I want to be, we'll move, in the introduction part, we'll move very cautiously, because this topic is, as you know, it's a compulsory question in exams, and you need to move with me right away from the beginning. So make sure that in case you find as if you are getting lost, kindly ask the question before you proceed, because it's kind of a chain. If you get lost at the beginning, it might give you difficulties in a later stage. So I'll start with group accounts. Group accounts. I'll start with introduction. I'll start with introduction. Then you write below that, when one company acquires more than 50% of the ordinary share capital, more than 50% of the ordinary share capital of another company, more than 50% of the ordinary share capital of the parent company, the first company becomes the parent company. The first company becomes the parent company, into brackets, holding company. Into brackets, holding company. And the second company becomes a subsidiary company. And the second company becomes a subsidiary company. A paragraph below that, a paragraph. When the parent company acquires exactly 50% of the ordinary share capital of another company, exactly 50% of the ordinary share capital of another company, the second company becomes a joint arrangement. To the first company. A joint arrangement to the first company. Then after that, when the parent company acquires 20% or more, but less than 50%, of the ordinary share capital of another company, 20% or more, but less than 50% of the ordinary share capital of another company, the second company becomes an associate to the first company. It becomes an associate to the first company. Then we proceed on. It becomes an associate to the first company. Then after that, a paragraph. When the parent company acquires less than 20%, when the parent company acquires less than 20%, of the ordinary share capital of another company, less than 20% of the ordinary share capital of another company, the second company becomes a simple stroke trade investment. A simple stroke trade investment to the first company. A simple stroke trade investment to the first company. Then, if no question, you write below that. Terms used. Terms used. The first terminology is parent company. It is a company that controls another company. It is a company that controls another company. It is a company that controls another company. Full stop. It is a company that controls another company. It is also known as a holding company. The other terminology is subsidiary. It is a company that is controlled by another company. It is a company that is controlled by another company. It is a company that is controlled by another company. The other terminology is control. It is the ability of an entity to materially influence the financial and policy decision making. The financial and policy decision making process of another entity, to materially influence the financial and policy decision making process of another entity. Another terminology, non-controlling interest. Non-controlling interest. The fourth terminology is non-controlling interest. Non-controlling interest. It refers to the minority shareholding. It refers to the minority. Minority shareholding. Minority shareholding. Minority shareholding in a subsidiary company. In a subsidiary company. E.g., for example, where the parent company controls 80% of a subsidiary. Where the parent company controls 80% of a subsidiary. 80% of a subsidiary. The NCI will be denoting to it as NCI. The NCI, or rather the non-controlling interest, the NCI or non-controlling interest, shareholders, the NCI shareholders, control if the parent company controls 80% of a subsidiary. The non-controlling interest will be controlling what percentage? Yes?
20%.
Yeah, the NCI control 20%. The NCI shareholders control 20%. Number 5. The fifth note is about something called goodwill. Goodwill. Then you write, it is the difference between the purchase price paid to acquire a subsidiary. The purchase price paid to acquire a subsidiary and the value of its net identifiable assets. Excuse me. Full stop. Then you write below that a subheading, methods of accounting for goodwill. A subheading, methods of accounting for goodwill. Methods of accounting for goodwill. The first, then you write below that, there are two methods used to account for goodwill. There are two methods used to account for goodwill. They include, number one, partial goodwill method. partial goodwill method. Partial. Then an explanation to that. In this case, only the goodwill attributable to the parent company. In this case, only the goodwill attributable to the parent company is considered. Only the goodwill attributable to the parent company is considered. Full stop. Continuation. Goodwill attributable to the NCI is ignored. Goodwill attributable to the parent company is considered. Yes? I've said in this case, only the goodwill attributable to the parent company is considered. Full stop. Goodwill attributable to the NCI is ignored. Goodwill attributable to the NCI is ignored. The screen will be back. Attributable to the NCI is ignored. Full stop. Number two. It is called full goodwill method. 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 Then explanation to that. In this case, both goodwill attributable to the parent, company, both goodwill attributable to the parent company and the NCI and the non-controlling interest, and the NCI we said is non-controlling interest, and the NCI are considered. Illustration. A simple illustration to illustrate that concept, just right below that illustration. Mulango Limited acquired 80% of the net assets of Kubwa Limited. 80% of the net assets of Kubwa Limited. 80% of the net assets of Kubwa Limited. 4 shillings. 480 million. 4 shillings, 480 million. Full stop. At the date of acquisition, the net assets of Kubwa Limited, 80% stood at shillings 500 million. Stood at shillings 500 million. Stood at shillings 500 million. Required. Compute the value of goodwill. Compute the value of goodwill. Compute the value of goodwill using Roman 1. Using.
Excuse me, sir.
Yes. Ask.
Kindly repeat after at the date of acquisition, the net assets of Kuba stood at
Shillings 500 million. Full stop. Required. Compute the value of goodwill. Compute the value of goodwill using Roman 1. Using Roman 1, partial goodwill method. Partial goodwill method. Using Roman 1, partial goodwill method, and Roman 2, full goodwill method. Roman 1, partial goodwill method, and Roman 2, full goodwill method. Solution. Are you ready?
yes.
What was the purchase consideration? Purchase consideration or purchase price? At what price did Mulago Limited acquire Kubwa Limited? That is what we refer to as the purchase consideration. Yes? $480, correct. Million. Our figures are in millions. Then we less share of net assets. We less share of net assets of Kubwa Limited. Remember, we only control 80% of the value of the net assets of the subsidiary. The total value of the net assets of the subsidiary stand at how much? At 500. Good. So 80% of 500. Use your calculator. It is coming to
I think 400.
400. So what is our value of our partial goodwill? The difference between 480 and 400, which I believe is 80 million. And that is how you determine the value of goodwill using the partial goodwill method. Partial goodwill method. So, not unless you have a question, we proceed on to full goodwill method. So, Roman 2, we are now going to use full goodwill method. Purchase consideration. It is the price paid by the parent to acquire the subsidiary. In this case, the parent paid Poite to acquire 80% of Kubwa Limited. Any other question? Okay. We know that our partial goodwill is 80 million. We know that our partial goodwill is 80 million. Our partial goodwill is 80 million. Then fair value of a NCI. Fair value of NCI. I think there I had an omission there. Okay, right. Fair value of NCI. NCI we said is non-controlling interest or the minority shareholders. Okay, I had an omission there. Just before required, make a correction. Just before required, indicate that the fair value of NCI was 120 million. I had forgotten that. Just before required, indicate that the fair value of NCI was 120 million. Just before required, insert the statement that the fair value of NCI was 120 million. So, going with that, if the fair value of NCI is 120 million, and we know that the NCI in this case, we write below that, less NCI share of assets. Share of assets. You less NCI share of assets. We know that the parent controls 80% of our subsidiary. In this case, Mulago Limited controls 80% of Kubwa Limited. Therefore, it means that the NCI control 20%. Therefore, the share of NCI assets will be 20% times the net assets of our subsidiary, which in total is 500. And therefore, assets attributable to the NCI will be 20% of 500, which is 100. And therefore, goodwill attributable to the NCI will be the difference between 120 and 100, which is 20. And therefore, our full goodwill will be 80 plus 20, in which case it would be 100 million. From where? The fair value of NCI we have inserted it to be 120, isn't it? The total assets of this subsidiary had been given in the question to be 500. And the NCI in this case only control 20% of that. So 20% of 500 is 100. So to get the goodwill attributable to the NCI, you take the fair value of NCI minus the share of NCI's net assets, which is 100, which gives us 20 to be the goodwill which is attributable to the non-controlling interest shareholders. And therefore, our full goodwill will be the partial goodwill plus the goodwill attributable to the NCI to get 100. Therefore, the only difference between partial goodwill and full goodwill is that this one, the first one, does not consider goodwill attributable to the non-controlling interest. It only considers the goodwill attributable to the parent company's shareholders. Okay. For examination purposes, the examiner will specify. The examiner will specify the method which you are supposed to use. it will be very clear on which method to use. At times, the question might be silent. It might be silent. In which case, it will depend on how the question has been framed. Because in the absence of the fair value, in the absence of the note that we have just inserted later, it means that you cannot be able to use the full method. It cannot be possible for you to use the full method. In which case, you must be forced to use the partial method. So if you're not given the fair value of NCI, straight away you're using the partial goodwill method. But where you are given the fair value of NCI, straight away you're using the full method. Any question? If no question, we proceed on. Okay, just right below that, consolidated statement of financial position. Consolidated statement of financial position, a subtopic, a sub-item. Consolidated statement of financial position. Then you write below that, it is prepared by combining, the assets and liabilities, of the parent company, with those of the subsidiary company, Full stop. However, only the capital and reserves, of the parent company, are included in the consolidated SFP, in the consolidated statement of financial position, in the consolidated SFP. Only the capital and the reserves of the parent company are included in the consolidated SFP, Kindly underline that last statement, that only the capital and reserves of the parent company are included in the consolidated SFP. Full stop. A paragraph below that. The following adjustments should be made when preparing the consolidated SFP. The following adjustments should be made when preparing the consolidated SFP. So we are going to look at some adjustments. To be precise, we are going to consider the 8 rules of consolidation. First rule, rule number 1, is about intergroup debts. So you write number 1, intergroup debts. Intergroup debts. Then you write these debts arise when the parent company and the subsidiary company, owe each other as at the end of the year. Full stop. Continuation. An intergroup debt is not a true debt. An intergroup debt is not a true debt. Since the parent company and the subsidiary company report under one roof. Since the parent company and the subsidiary company report under one roof. And for this reason, an intergroup debt should be eliminated as follows. Debit group payables account, credit group receivables account. Debit group payables account, credit group receivables account. So that's how you account for an intergroup debt. Any question? So, if none, rule number 2 or adjustment number 2, cash in transit. Cash in transit. Then you write below that it arises when the parent company or the subsidiary company, sends cash to each other, but the amount happens not to have been received, by the receiving group member, as at the end of the year, In this case, debit, group cash account, credit, group receivables account. That means to adjust for the cash in transit, you debit group cash account and then you credit group receivables account. Any question pertaining to cash in transit? Any question in regard to cash in transit? Yes?
So the cash is assumed to have been received from the debtor.
Okay, I will clarify on that. Of course, cash, is expected to be received from debtors. And for purposes of clarifying that, one group member, when the creditor sends money to the debtor, what will happen is that in the books of the creditor, in the books of the paying group member will adjust. Kindly adjust the screen. The sending group member will adjust his payables because, of course, he has remitted the cash. But the receiving group member has not received that money. And therefore, between the receivables and the payables, which account is not up to date? Is it the payables or the receivables? The receiving account or the receivables. Therefore, as far as the payables is concerned, it is up to date because the sending group member adjusted his payables. But the receiving group member has not received the cash, and therefore his accounts receivable is not up to date. Is it clear now? Are you okay now? Okay. Any other question before I proceed on? Okay. We move on to the third adjustment, which is a very crucial adjustment. Adjustment number 3. Adjustment number 3 is known as accounting for unrealized profits. Accounting for unrealized profits. Accounting for unrealized profit is our adjustment number 3. Accounting for unrealized profit, which is our third adjustment. Then you write below that. It arises when one group member. By saying one group member, we mean either the parent or the subsidiary. One group member sells goods to another group member. Sells goods to another group member. At a profit, sells goods to another group member at a profit. At a profit. At a profit. And the purchasing group member and the purchasing group member.
Oh, okay. Sawa. Acha nirudi huko.
And the purchasing group member happens not to have sold the goods. 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 Or part of the goods. Or part of the goods. Or part of the goods. As at the end of the year. As at the end of the year. As at the end of the year. In this case, the amount of unrealized profits, the amount of unrealized profits, the amount of unrealized profits the amount of unrealized profits should be adjusted, depending on whether it is from a downstream or an upstream, depending on whether it is from a downstream or an upstream transaction. From a downstream is like this, downstream. Depending on whether it is from a downstream transaction or an upstream transaction. Just below that, a small item, downstream transaction. Downstream transaction. A small item below that, you clarify what is a downstream transaction. Downstream transaction. Downstream transaction. It arises when it is the parent company. It arises when it is the parent company selling goods to the subsidiary. It arises when it is the parent company selling goods to the subsidiary company. That means, for example, if you have P, which is a parent, controlling 80% of S Limited, which is a subsidiary, when it is P Limited selling goods to S Limited, that is what we call a downstream transaction, because as you can see, goods are flowing from top downwards. Full stop. In this case, debit, group retained profits account, debit, group retained profit account, credit, group inventory account. Debit, group retained profits or retained earnings account, credit, group inventory account. That is a downstream transaction. Below that, upstream transaction. upstream transaction. It arises when it is the subsidiary. It arises when it is the subsidiary company. It arises when it is a subsidiary company selling goods to the parent company. Selling goods to the parent company. Selling goods to the parent company. Supposing that this is P Limited and this is S Limited, 75% owned. When goods flow upwards from S to P, that is what we refer to as an upstream transaction. Goods are coming from the subsidiary back to the parent. In this case, debit, group retained profits account, debit, group retained profits account, group retained profits account, with the parent share, with the parent share of unrealized profits, with the parent share of unrealized profits. Again, debit, non-controlling interest account, NCI account, non-controlling interest account, debit NCI account with its share of unrealized profits, with its share of unrealized profits, with its share of unrealized profits. Then you credit group inventory account. You credit group inventory account with the total unrealized profits. Group inventory account with the total unrealized profits. Now, before we proceed, in this case, a very serious challenge arises. The examiner again will be looking on whether you know when to apply markup and when to apply margin. Therefore, for example, if you are told that, for example, I'll use some 2 or 3 illustrations. H Limited sold goods. H Limited sold goods to S Limited for shillings 40,000 at a markup of 25%. And then you're told at a markup S Limited still held half of these goods as at year end, required. Compute the unrealized profits. I've said H Limited sold goods to S Limited for shillings 40,000 at a markup of 25%. S Limited still held half of these goods as at the year end. You are required to compute the unrealized profits. Now, my first question is the 25% markup applicable on the 40,000 directly without conversion. Is that okay? In other words, markup, what you're supposed to know is that markup is profit expressed on the cost of the goods. It is profit expressed on the cost of the goods. Margin is also profit, but in this case, expressed on the sales or the selling price of the goods. So is it in order for you to apply the 25% on the 40,000 to compute the unrealized? No. It is not appropriate to do that because this 25% is markup. H Limited sold goods to S Limited for 40,000. That means that the 40,000 is selling price. Therefore, for you to apply this 25% on the 40,000, you need to change the 25% to margin. We said, how do we change markup to margin? Yeah, 25% is equivalent to a quarter, you're right? It is still markup, so to change it to margin? Yeah, 1 over 5. You add the numerator to the numerator, the numerator to the denominator. So it is 1 over 5. Now it is margin. Now you apply 1 over 5, now it is in order, times the value of the goods, which is 40,000, and only a half of the goods were remaining in the closing inventory as at the end of the year. So in this case, 1 over 5 times 40,000, which I believe is 8,000, times a half, which is 4,000. And therefore our answer is 4,000. So the most important thing is to know how to convert markup to margin and margin to markup, and to know when to convert and when not to convert. That one is very important. First, in the first place, you know when to convert and when not to convert. Whenever you are given selling price and margin, there is nothing to be converted. And then you know how to convert. The biggest challenge comes in on how to convert, because sometimes it is not a must that you are given percentages which are in full numbers. Sometimes you can be given percentages which have fractions. For example, if I may ask you, attempt to convert for me a markup of 16 and 2/3%. Change this one to 2/3%. Change this to margin. And you give me the answer in form of a fraction. Change 16 and 2/3% markup to margin, and then you give me your answer in form of a fraction. 1 minute to do that. You have 1 minute to do that. Yes, Dr. Are you done?
Yes.
What is the answer?
16 2 over, no, 2 over 5.
16 2 over 5. Okay. Dahil, what about your opinion? 3 over 21. That one is a bit challenging. So, where you're given 16 and 2/3%, and it is markup, it is important that you first of all put it into a proper fraction. So, 16 times 3 gives how much?
48
Plus 2, the numerator. 50
over 7.
over 3. Remember, it is a percentage, so it is not over 3. Over 3, 100, because it is a percentage. Therefore, if you simplify that, it will be divide by 50, 1, divide by 50, 300 divided by 50, 6, isn't it? But remember, it is still a markup. It is still a markup. So, this 1 over 6 is still a markup. We want to change it to margin. So, you add the numerator. So, you add 1. And therefore, our answer is 1 over 7. 16 and 2/3 markup. Yes? Yeah, it is equivalent. If you multiply by 3 times 3, it will be, it is okay. 3 over 21 is, yeah. But of course, it is better when you put it in a more simplified form. Any question? So you need to be very careful when it comes to conversion. You need to be very careful when it comes to conversion. If markup is 2 over 5, this is markup. Margin will be
2 over 7.
2 over 7, correct. So remember that it is the numerator that you add to the denominator and not necessarily 1, because most candidates happen to add 1 instead of the numerator, because it is not necessarily that the numerator is 1. Sometimes it can be a different value. Okay, not unless you have a question on the issue of unrealized profit, we can move on to the next concept. So make sure that you are very keen when it comes to markups and margins. So let's proceed on to the fourth concept. Concept number 4 is about, number 4 is about fair value adjustments. Fair value adjustments. Fair value adjustments. Then you write below that. Oh, before you write below that, into brackets, it is also known as revaluation adjustments. Revaluation adjustments. So, fair value adjustments is the same as revaluation adjustments. Then you write below that. It arises when the assets of the subsidiary, it arises when the assets of the subsidiary, are revalued at the date of acquisition of the subsidiary, are revalued at the date of acquisition of the subsidiary. Full stop. In this case, the amount of revaluation gain, should be shared between the parent company should be shared between the parent company and the NCI. Between the parent company and the NCI. Between the parent company and the NCI as follows. Debit asset account. Debit asset account with the total evaluation gain. Debit asset account with the total revaluation gain. Credit cost of control account, cost of control account with the parent's share of the revaluation gain. Cost of control account with the parent's share of the revaluation gain. With the parent's share of the revaluation gain. Credit NCI account, credit NCI account with its share of the revaluation gain. Credit NCI account with its share of the revaluation gain. The screen will be back. So you credit NCI account with its share of the revaluation gain. Adjustment number 5. Adjustment number 5. Depreciation adjustment. Adjustment number 5 is depreciation adjustment. Depreciation adjustment. It arises when the revalued assets of the subsidiary. It arises when the revalued assets of the subsidiary are subject to depreciation. Are subject to depreciation. Are subject to depreciation. These results to a depreciation undercharge. These results to a depreciation undercharge. To a depreciation undercharge. In this case, debit group retained profit account. Group retained profit account. Group retained profit account. Group retained profit account with the parent's share. With the parent's share. With the parent's share of depreciation, with the parent's share of depreciation. You also debit NCI account. You also debit NCI account with its share, NCI account with its share of depreciation, NCI account with its share of depreciation, and then you credit asset account with the total depreciation. You credit asset account with the total depreciation. Okay. Adjustment number 6. Adjustment number 6. Intergroup sale of non-current assets. Intergroup sale of non-current assets. Intergroup sale of non-current assets. It arises when one group member sells a non-current asset to another group member, sells a non-current asset to another group member at a profit. Full stop. In this case, with the amount of unrealized profits, debit group retained profit account. Debit group retained profits account. Debit group retained profits account. Credit group asset account. Full stop. A paragraph below note 6, another paragraph just below that note. With the amount of excess depreciation, arising from the unrealized profits, debit group asset account, debit group asset account, credit group retained profit account. And finally, the last point today, number 7, accounting for pre-acquisition dividends. Accounting for pre-acquisition dividends. Accounting for pre-acquisition dividends. Accounting for pre-acquisition dividends. Then you write below that, these are dividends arising. These are dividends arising from the subsidiary company, before the date of acquisition. Before the date of acquisition of such subsidiary. Before the date of acquisition of such subsidiary. Full stop. These dividends should be treated. These dividends should be treated as pre-acquisition reserves. Should be treated as pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves as follows. Debit, group retained profits account. Then you credit, debit group retained profits account, and then you credit the cost of control account. You credit cost of control account. Cost of control account. And finally, number 8. Let's adjust for the last one. Number 8. Purchase consideration through a share exchange. Purchase consideration through a share exchange. Purchase consideration through a share exchange. Through a share exchange. Purchase consideration through a share exchange. Then you write below that, it arises when the parent company settles the purchase consideration. On acquisition of the subsidiary, by issuing out its own ordinary shares. By issuing out its own ordinary shares. In this case, to determine the amount of purchase consideration, the following formula is applied. Purchase consideration is equal to market price per share of the parent, market price per share of the parent company, times percentage shareholding in subsidiary, times exchange ratio. Exchange ratio, full stop, times the exchange ratio. So we'll stop at that. Is there anybody who has a question before we stop? We end our class. So next time we'll consider the income statement, and then we do a past paper question. We'll do a past paper question before we proceed on with the other part of group.
Wednesday 4.
That will be on Wednesday at 4. It will be on Wednesday at 4. So if you don't have a question, let's meet at that time. You can have a nice weekend.
Thank you.
Welcome.